So SCHY is the Schwab International Dividend Equity ETF. And since its inception back in 2021, this ETF is down around 4.4%. Okay, so this is a newer ETF. It's not up that much, but one of the interesting things about this ETF is that it's just like SCHD. It's kind of like if SCHD had a twin, but that twin happened to be French.
Sacre-bleu.
And this is actually because SCHY only invests in international stocks, but it acts just like SCHD. Okay, so to compare why SCHD and SCHY are so very similar yet so very different, I made this graphic for us. And if you watched my recent video on SCHD, this is the same graphic. I made this same graphic though for SCHY. So what are we looking at here? On the left side, you can see the Dow Jones Broad Market Index. That's the first index that you can go to find potential stocks to go into SCHD. There are 2,526 potential stocks that SCHD can add to the portfolio. Then it goes through a few different screening processes and it gets to only 100 stocks at the end. That's what we're looking at here. This is the process to get to those 100 stocks. Now, if we look at SCHY, we're looking at the same thing. On the left side, you have that you can go with the Dow Jones Global XUS Large Cap and Mid Cap Market Indexes, and there are 5,991 eligible stocks in those indexes that we can look at here, and how these screen out to get to the fact that you only have 100 stocks left. Same kind of deal. SCHD takes out REITs first. So first off, let's say there's 225 REITs inside the US. It takes them out. You can't have REITs in SCHD. It screens them out. By the way, let me just make sure that you understand these are just my best guesses for numbers. These aren't exact numbers. I don't know the exact amount of stocks that are going to be screened out in each of these little stages, let's say, but I just think that these are my best guesses. I think they're pretty close maybe. But again, not exact numbers. Don't quote me on this, I guess I'd say. So if we look at SCHY, now we are going to take out REITs. Now, we're talking international stocks, so basically outside the United States. So, I don't know, I'm just assuming, let's say there's 640 REITs. I don't know the exact answer. That's just an assumption. And okay, that leaves us with 5,351 non-REIT stocks that could potentially go into this. Okay, let's go back to SCHD. Now we're looking at, let's say, defining a universe. And 1,851 stocks, I'm assuming, aren't actually going to pass these criteria. So only about 450 will. What are the criteria? Minimum 10 years consecutive dividend payments, 500 million market cap, so basically how big the companies are. Average daily trading volume has to be at least 2 million, okay, for the past 3 days. So that's it for that part. And only, let's say, 450 stocks make it into this part. Let's look at SCHY. Now we have a similar thing. Okay, we have to define the universe. The universe here, let's say we get to 802 stocks left out of the universe. Same actually thing, right? Minimum 10 years consecutive dividend payments. Same thing as SCHD. 500 million market cap, same thing. 2 million of trading volume. Now this goes back 6 months instead of 3 days. Bit different, but whatever. Okay, similar. There's other thing in here too. It's really just about the domicile of the companies, which of course we wouldn't have that in SCHD. Not a huge deal for this one. I'm actually going to brush over this basically. So let's go back to SCHD. Now here at SCHD is where you go into the factors. And this is where it's different than SCHY. Because SCHD, it only has one more little thing that we're looking at here, and then it gets to the factors. Well, SCHY has something else here. I actually broke this out so we understand that this is different. So I'm going to call it like a second part of this defining the universe. And this is you have to have stocks that are greater than or equal to the median dividend yield. So what they do is they take all these, let's say 802 stocks, they take all their dividends, and they say, what's the median dividend? What's the dividend right in the middle of all those different dividends? All the stocks that are above that median, they're actually going to pass this part of the test. Now they can go to the next part, which is where we're going to create basically a score, and we're going to use 4 different factors to figure out the score. Now, this is also how SCHD works. And actually, it's the same factors, right? So very interesting. We have free cash flow to total debt. We have IAD yield, that's basically the dividend yield. We have the shareholders' equity, or return on equity, sorry. And then we have 5-year dividend growth rate. So after creating a ranking with all of these different factors, the best stock that makes it out of these rankings, the top 100, they make it in. These are pretty much the same, right? There is that little part about greater than or equal to the median dividend yield. And so that is that little weird different thing, but it's pretty much the same, right? They use the same factors, pretty much very similar. Of course, the other deal is that this is only for international stocks, SCHY. SCHD is only for US stocks. Those are the main differences. And so why does this matter? Why did I just show you that crazy graphic? Okay, I'm going to make a point here. This is an important point. Sometimes US stocks don't do as well as international stocks. We all love our own country. We have our own bias for our own country and the stock market there, but sometimes we underperform international stocks. Now, this is the interesting part because you might have started investing not too long ago and you would not know that because it's been such a long period of US stocks outperforming international stocks. And you'd probably think to yourself, why do I even need to have any international exposure? Well, I'm going to show you why. On the right side here, we're taking a look at how much more of a return US stocks have been than international stocks. Now, this is crazy. It's been 15.2 years since US stocks have been outperforming international stocks. And that's why when you look back and you're like, well, if you're kind of new to investing, you wouldn't even know this, but we have made 225% more in the US than actually developed market international stocks. Okay, so you have things like developed markets inside Asia, developed markets inside Europe. Okay, so you're gonna have developed markets. Okay, so we have had huge outperformance in these markets from the US perspective. The US has done much better, 225% better. Now, go back before that. If you look at these 7.3 years back, let's say early 2000s, 64% outperformance for international. So in that time period, you would have wanted to have some international exposure because it did a lot better than the US. Throughout a lot of the 90s, the US did do better. Then there was a period of time where international developed markets did better. And then you had the 80s basically where there was huge outperformance in a lot of these developed markets. 374% outperformance by going with international stocks here than if you had just stayed inside the US. So again, you would have had a lot of return, extra return, if you had had some exposure to international. This is basically just the point here. So there is a potential that sometimes international stocks will do better than US stocks. I don't know when it will be. I don't know if it's going to be 20 years total from that last time that it happened. We're at 15.2 years. I don't know. But I just know it's going to happen sometime soon. We could create a whole nother video on whether or not that would happen in the near future. But you know what? I think maybe at some point in the near future it can happen personally. So that's why I am thinking of having some additional international type of exposure for myself. Okay, let's compare these ETFs. So I'm looking for a little bit of international exposure. Let's take a look at these ETFs and compare them to each other. First, let's take a look at SCHD. We know that this is the Schwab US Dividend Equity ETF already, and the expense ratio, because you want to know how much money you're going to be paying for this ETF, is only 0.06%. Super cheap ETF, and if you take a look at the distribution yield, it's 3.32%. So you're going to be making on $10,000 invested, you'll be making $332 every single year. This looks pretty good to me so far, right? So now, okay, let's take a look at SCHY. Can SCHY compete with SCHD? SCHD, of course, has a cult following. A lot of people love it, so it's going to be pretty tough. Let's take a look. So we have the Schwab International Dividend ETF, SCHY. Expense ratio, it's going to be a little bit more money to have SCHY, 0.14%. Is it very expensive? Not in my opinion. When I get up to maybe the 0.2% plus, I start feeling it a little bit, you know, when under 0.2% or under 20 basis points, you would say, I'm okay. Of course, lower expense is always better, but if we're gonna get hopefully some decent returns, if international stocks do well, okay, maybe I'm willing to pay this amount of money, and the distribution yield is 3.58%. Now, here's a kicker on this one. The 30-day distribution yield is actually 4.44%. So when you take a look at the shorter term, because interest rates have been nuts lately, well, sometimes you want to take a look at the 30-day and see what's going on. Well, we have a much higher yield if you took the 30-day currently and you made that annually. So it's potential that SCHY does have a much better yield than SCHD, at least when we look more in the short term. SCHD's 30-day yield is only 3.48%. So, you know, it's potential that it's got a much better yield. $358 if you had $10,000 invested right now. Now that's for that longer period yield right now, not the 30-day SEC yield. And then let's take a look at the holdings, 100 holdings. Of course, in each of these, we just went over that. So we do know these are pretty much the same in the amount of holdings. So what do I think about this? There's no way to know if the factors that have been working out well in screening stocks that have done well for SCHD, giving us good yield, and also, of course, giving us great capital appreciation. We don't know if we're going to also get that when we go to international stocks. What we can do is we can compare this right now and see how it's looked over the past few years. So when I compare SCHD to SCHY, and we only go back here until basically the very start of 2022, we have $10,000 invested in SCHD growing to $9,550. That's a negative 3.87% rate of return. But then if we take a look at the international dividend equity ETF, negative 6.34%, and $10,000 grows to $9,265. So there was a bit less of a return so far when comparing SCHD to SCHY. SCHD has done a bit better. Now, let's take a look at SCHY. We're going to compare this to VXUS. That's a Vanguard X United States ETF. So it's got basically all the different stocks around the world in it, except for the United States. VXUS was actually down almost 11%. So the SCHY ETF did better than VXUS. So maybe that dividend component or those factors that it's screening for, maybe it's actually going to do a good job. So far, the screening mechanisms that SCHY have done have outperformed VXUS, and that's actually interesting to me. So far, I think SCHY could be a potential to throw into the portfolio. I'm not doing it yet, but I'm thinking about doing it. So that's all I have for this video. I hope you liked it. Now, if you want to see a video on how to create a 3-fund portfolio with Charles Schwab, take a look at this video here, disclaimer here, and see you next time.